All right, guys, welcome to another week of the Educated Home Buyer Live with Josh and myself, here to update you on what's happening in the economy, update you on mortgage and real estate, and more importantly, we're here to answer your questions. For you guys that are just joining us now or whenever you jump in, you don't see what happens behind the scenes. So we played the intro music. We had everything going. I actually came in here and said the full intro to realize that I never hit the live button. So we weren't actually broadcasting anything. It was just Josh and I talking back and forth. But here's the good news. We're live now. We're here to update you on what's happening in the economy. We're going to talk about mortgage rates, which is really one of the biggest movers, right? Mortgage rates hitting 4-month lows. We've seen a lot of positive activity pick up in demand because of that, purchase applications and people refinancing. So we're going to do that. But while we're answering questions and updating you on the economy, let us know where you're watching from. And start putting your questions in the chat. Helps the show flow a little bit better. And that's that. So Josh, welcome for the second time.
I'm glad to be here for the second time. I didn't get to say I was happy to be here, but I think you said something along the lines of having a great day, good Wednesday. And like, it is not. You people
I said
around
happy
the country.
Wednesday.
Happy Wednesday. I said
it's a happy Wednesday.
It's not.
You're alive. You're healthy.
I'm
you have your
alive.
health.
I'm suffering with
Do you have
rain.
your
There's
health?
water pouring down on my head when I walk outdoors.
Do you have your health, Josh? That is the important piece here.
As long as I
Without
don't
that, you
melt.
have nothing, right? So with that, we're not gonna drag out on and talk about bad things. So congratulations to my clients who closed today. They got a $50,000 grant. So good news to them. Free money here in Southern California. They bought in South LA. That closed today. So congratulations to them if they're watching. They gave me a nice little gift basket, Josh. They gave me card. We got the house. Nice little note here. A gift basket full of goodies. But anyway, that's not why we're here. We're here to talk about what's happening in the market. And so with that, we are going to start by updating you on inventory as we always do each week. This week, we actually saw a tick down a little bit in inventory to 639,000 homes, just over 639,000, a little less than 1,000 homes week over week declined. We got 28.3% more homes on the market this time than last year. Actually, last year, Josh, we were sitting at around 500,000 homes, just short of 500,000. So to see that increase is a nice thing out there for buyers. But as I mentioned, we went from 640,221 down to 639,485. Back in 2015, inventory was sitting at about 962,000 homes. So considerable difference from back then. Orange County as a whole, we saw an uptick at 3.58%, sitting at 3,239 properties. I want to be clear here when I talk about these numbers because the overall inventory that I mentioned is single-family homes nationwide. Orange County and Huntington Beach, when I talk, it's all properties, single families, townhomes, condos, senior properties, properties on leased land, multi-million-dollar, everything is thrown in there. So once you kind of factor some of that stuff out, you start to remove some of the things that you wouldn't really be a buyer for. You realize how low inventory actually is. So Huntington Beach sitting at 217 homes. That's down 1.38% week over week. And I threw some charts in here from Calculated Risk. These numbers are from January, but it just shows nationwide inventory. I like to look at the far two columns, just showing year over year active inventory versus 2019. I highlighted or put a box around those markets that have more inventory now than back in 2019, because those are the markets really to watch more so than the ones that are still deeply negative. Virginia, Rhode Island, some of these markets, way less inventory. Illinois, like way less property. Whereas when you look at some of these others, Dallas, Denver, Jacksonville, Nashville, Phoenix, all have positive inventory. And DC has some positive inventory, but it's not the big jump that a lot of people out there have been talking about, just up 5% compared to those 2019 levels. This, again, is an active housing inventory chart for February. This came from Resi Club, a little bit different chart. Again, the top are the ones that have seen the biggest increase in inventory, that green to light green area, whereas everything that's a brownish color is still flat or negative. But Josh, look at the bottom there, down what 80% or something inventory compared to the same time. Was it this back in 19 or is this last year?
To February 19.
Yeah.
And
So
the crazy thing is, if you look how regional these things are, you
yep.
know what the names are at the top, and you know what the names are at the bottom. We got what do we got? Maryland, Ohio, North Carolina, Massachusetts, Connecticut, all that Northeast stuff is really hot. The West is kind of in the middle, and then you got your Gulf Coast states up there at the top.
Yeah. And with that, I mean, it's California, the prices, right? It has a lot to do with affordability in some of these areas and a desire to want to be in some of these markets, right? It's, people are moving for different reasons, but a lot of that area that people are moving is lower taxes overall, better climates, just different things.
Resi Club Jeb did a great breakdown on Florida, and it's not as simple as condos. It's not as simple as hurricanes. There's about 5 factors there that are impacting it, and one of the biggest ones is the nation as a whole. Nationwide, we saw about a 41% increase from the beginning of COVID through 2024. They saw a 51% run up in prices, so it was a little more frothy. They were getting more of the people who were free location wise and able to relocate and take their job with them. And they saw some more of that. So they have a little bit more room to give back than most markets.
Exactly. Unsold new listings ticked down second week in a row, sitting at 53,000 properties. They're slightly more this year than last year. But here's my guess, Josh, with rates coming down, moving from 7.25% in January to, I don't know, 6.5%-ish, depending on how qualified you are today. Almost a 0.75% move. My guess is that's going to start to unlock a little bit of inventory. People that were thinking of selling anyway, maybe put some on the market a little bit sooner. Maybe there's some people that weren't 100% sure what they were going to do, and we're moving into that time when properties are naturally going to come to the market because of the spring. So, new listings, same chart we looked at earlier. Just the difference is that was active inventory. This is new listings. Follows a similar pattern with the same cities compared to 2019. So you can check that out. This is months of supply. This also came from Calculated Risk, maybe Resi Club. Not sure where this one came from exactly, but Miami area, over 10 months of active supply. San Antonio, Jacksonville, Louisiana, mid Florida, like all of those areas for the most part are southern. Georgia. I guess Nashville's not, but sitting at 5 months of inventory. Dallas is on there. Alabama. Alabama's on there. So a lot of the southern parts of the U.S. That saw a big run up is where you're starting to see inventory grow. And again, it has to do those factors that you were mentioning there a moment ago, Josh. Home sales. Let's see. Median price of this week's pending home sales came in at $389,900. 2.6% higher than last year at the same time. Or is that's this chart actually. This chart here, I said the wrong one first. The number of sales jumped by 7% of the week, but it's still running 3% below last year at this time. 60,000 new sales started for single family homes. And then we talked about this one just a moment ago. And then price cuts sitting at 33.7%. And that line is ticking up a little bit, Josh. So we'll continue to follow. It looks like it, if it follows similar patterns as to what we've seen historically, or, I say historically, going back last 10 years or so, whatever's on this chart, you're going to continue to see that rise all the way until September, October. So you're likely going to see price cuts come up.
I got a question for our real estate expert here. Stay on that chart here. Yeah, let's get back to it. Like I look at that and think, so our home buying season, we're about ready to kick in. We're past the Super Bowl. We spring forward this weekend, longer daylight hours to get out and start looking at homes after work. Why would the price cuts tick up later in the year as the year goes on? Why would they continue increasing?
Well, I think you start to see more inventory come to the market now, right? So you got more homes on the market. You're having to compete against, because if you look at the green one, what the turquoise one there, what's that, 23, which was one of our, I guess, back to closer to a more normal market, out of the 22s and 21s. But my guess is there's more homes on the market. Everybody's trying to remember this. Any price cut, whether it's $1 or $100,000, is measured as a price cut. So how many homes get the exact price that they come on the market at, right? Sometimes they sell over asking, but for the most part, it's right in that range. So my guess is the reason you see those numbers start to tick up is because that's when the most transactions happen, is between that period of time, between April and September-ish. And those homes closing, oftentimes they're not 100% of exactly what was asked up there. And or if they are, sometimes people price them high to begin with and they end up selling for what they should have. And that's a price cut, right? So I don't know. That's my theory. I don't know that that'd be 100% accurate.
Yeah, it's a tough one to answer for certain, but it's a little counterintuitive looking at the chart.
Yeah. So with that, joshing, housing markets where home prices are falling, Josh.
Punta Gorda is always the top of the list, like literally every list. A lot of these things, you'll see a different list, a different source, someone else's data, and it's a different city. Punta Gorda is always the winner, no matter whose data is.
What drives me bananas, though, is like people using the word falling, collapsing, without any context to say what that number is. But like housing markets or home prices are falling. I'm assuming they're referring to everything on this list. And then you look at the Tucson at the bottom, and it's essentially flat. Yeah. I mean, I would say that
the bottom 10 are all essentially flat.
Yeah, but that's not falling. So in my eyes, falling is a big number, more than 5%, probably 10 or more percent is falling. But nevertheless, there are markets out there that are definitely different than what we've seen over the last couple of years. So if you're in one of those markets, make sure you're paying attention to the local data. This one, Josh, home builders who say deportations and or changes in immigration policy have affected their labor force. So that was a big thing as part of Trump's policy, is that, hey, all this immigration is going to impact home builders, and that's going to translate into higher pricing and all of this stuff. At the moment, 89% of home builders out there are saying it's having zero impact at all. Now, we're in the early stages. It's not going to happen immediately, so this will be something to watch.
Yeah, I take all polls with a grain of salt, because there's always lunatics out there that will say whatever. Like they get up one day and the wind is blowing this way and they say that, and they go the other direction the next day. I was watching a video the other day. I believe like total, like planned and not planned, like in process deportations is less than 10,000 right now. So I don't think that we have a lot of construction workers that have been impacted by this at this point, because most of those people were strong targets for enforcement. They're not just Joe citizens going about their business.
Your bigger worry about pricing should be around tariffs at the moment and lumber pricing and that sort of thing, which is in full effect at this time. That's in effect. The auto
this minute right now, as we speak.
That is part of it. So that should be more of your concern than, say, immigration. But Josh, we saw some news today that was positive on the employment front, if you weren't affected by it, I guess. But it's a positive thing for mortgage rates, assuming Friday cooperates.
Absolutely. So we had the ADP data. ADP is sort of a preview of some sorts of the non-farm payroll report that will be out on Friday. It does not really get traded. This actually was below expectations. I didn't put the raw numbers in my notes here, but under 100,000 jobs created. 77,000, and they were expecting like 110, 112. So it's not a huge miss, and it's still positive. This is
like 140 they were expecting.
Okay, so it's not net job losses, but it's way less jobs created than expected. For the first time, goods outpaced services, which is good, because from the perspective that the inflation has been largely focused in service-based things that we consume. So from that perspective, it may be good for us. This chart here is a really good one, Jeb. It just kind of shows that ADP is absolutely not predictive of what happens Friday, and that's why the market doesn't trade it very strongly. You'll see months here where the teal line was much higher than the purple, and you'll see other months where the purple was higher than the teal. So the only one that really gets traded is Friday's these figures, and we're probably going to see a light figure. The market's not expecting a big number for Friday, and they're probably not going to get a big number. So in the big picture, don't know that it's going to move a whole heck of a lot right now. Is just the uncertainty of tariffs and how it impacts employment going forward. No one's going to have seen it just yet. This one, Jeb, you and I don't hardly ever throw this Atlanta Fed GDP now number in here because it is really volatile and it changes a lot towards the end of the quarter. As they get more and more data, people will freak out on it here at the beginning of the quarter, and by the end of the quarter, they've got more and more data and it adjusts. But that is like falling off of a cliff over the last few days. They went from expecting 2.1 down to almost a 3% negative. That will correct. That's going to moderate, but it's definitely something to watch as we go forward, because some of the impacts of the tariffs would be a decrease in GDP as there's just less economic activity. So this, I'm not super interested in it now, other than we haven't seen anything like this in quite some time at any point in any quarter for the last several years. So we want to keep an eye on it and see what it looks like going forward. Jeb, I thought this was really important. And I just quickly, just looking at this, what does this tell us? This is all uncertainty of different degrees of what we're looking at. And during those times when we're going through uncertainty, this is what's funny. This is a chart, the percentage of U.S. household total stock holdings as a percentage of total assets. So Americans have more of their wealth in the stock market than ever before. And to some degree, this is a good thing, right? You want to be fully invested where you're able to take advantage when the market is doing well, and it's done very well over the last few years. But when we are more invested than we ever have been, it tells you that a lot of households are sitting on a lot of gains, and they may have gotten complacent, because we look here. I don't know if you saw this one, Jeb, but Warren Buffett is doing the opposite. He is taking his money out and going to cash as much as possible because he doesn't see good places to employ it. So this is your classic appeal to authority. He's smarter than us. He must know something. We're all dumb. So take it with a grain of salt, but it is something to watch. For those of you with nice 401k balances, for those of you just starting out with a smaller 401k balance, if you have a 50% drop in that balance, a 50% correction in the stock market takes 100% gain to get it back. So be careful, be defensive, know where you're invested. Don't just set it and forget it. I'm not saying take the money out of the market, but you want to be keeping an eye on it and managing it. Jeb, so I didn't put my nice little box here of where we've been in the last 5 days, but about this time last week, we were breaking out of that channel to the bottom. We were talking about that pink line, which is the 200-day moving average, and saying we needed to break below it and stay convincingly below it for a number of days. Well, yesterday and today, we went back above the 200-day, back into that channel. So this doesn't mean that rates are going to go back up to 7.25, but it means the short-term momentum is for higher interest rates, even though we may still be in this longer-term down channel. There's so much uncertainty right now that if you are in escrow, if you're looking to close in the next 15, 30, 45 days, you probably just want to be locked and stay the heck away from it. If you're looking at refinancing, we have a lot of folks who are at the point of looking and going, that's a couple $100 a monthly savings. Do I want to do it or do I want to wait? And some people are going, rates are going to go lower because over the last 6 weeks, they've dropped 0.5%. They may go lower, but they just don't go lower in a straight line. So that chart is important to see that. Here from Mortgage News Daily, we're a little bit lower than where we were last week, 0.25% lower than where we were a month ago, 3/8 to 0.5% lower than where we were a year ago. But day by day, we're a little bit higher than where we were. So a little under 675 on the 30 for well-qualified borrowers. FHA is in the low, and VA in the low sixes. So as always, well-qualified borrowers are going to do a little bit better than that. Mortgage News Daily does a really good job of giving you realistic numbers. But that's what I got, Jeb.
No, good stuff. And if you're out there, you got a mortgage, you're trying to refinance in the future, let us do the rate watching for you. You can go to jebsmith.net/rate watch, and we'll let you know when rates move down so that it makes sense, so that you don't have to track it every single day, right? We do the tracking on your behalf. So you can put your information in there, and you'll be on that list and essentially forever. So hopefully that is helpful to you. Josh, I said this week to you that interest rates needed to pause. Like, we can't continue the downtrend, right? We saw interest rates again drop a lot in a week period to some, probably 0.5% almost in some ways. It's good. Nobody wants to see rates move up if they're buying a home or if they're trying to refinance. But the reality is, it creates stability when things move sideways and you've got a little bit of give and take on both sides. So when you have a straight downward move, which is essentially what we had leading up until yesterday, it creates the opportunity for huge moves to the upside. And so when you get some of this give back, give and take on rates, it creates less opportunity for that crazy volatility that you could see. So while it's not ideal for everyone out there, it is a good thing that we, kind of seen a little bit of give back, and hopefully we could trend sideways, maybe up a tick, down a tick here and there, and then that allows the next move downward, which is less pressure on it, throwing it up to the upside. So
At first, when you mentioned that 0.5% in a week, I'm like, what's Jeb been smoking over there? But then I've said, let me pull up the chart because it did drop pretty quickly. We went from seven trading days from a little over 450 to down to 4.14. So it's at least a 3/8 in rates in 7 trading days. That's too much, too fast. We really, like, slow and steady wins the race. We talked about it in the fall when rates were dropping so fast. We got probably 6 weeks ahead of where I thought that chart should have gone. Not that the world doesn't always follow logically. Things happen. And some of that was a reaction to too much too fast. So in the big picture, I think this is better. You also, as a customer and wanting to experience this, you don't want rates to drop 1% in 2 weeks. Maybe that gets you in the door, but you're going to have a more frustrating experience. For us, it means we're here from 7 a.m. until 9 o'clock at night. We're tired, we're stressed, making more errors than you otherwise would, having a harder time getting back to people, getting them correct answers. So we would like an orderly process here. Even if I would love more loans and you would love to lower your interest rate, it is better that they come at a steady pace versus just falling off of a cliff.
All right, good stuff. We have Leanna watching from Oklahoma, R. Baker from New Jersey, Dixieland watching from Minnesota. What else do we have? I think that's all the people.
Darren's in Illinois. Good evening from Illinois.
Darren in Illinois. That looks to be everybody that let us know where they're watching from. So appreciate you guys checking in every single week and being here. Without you guys, we wouldn't be able to do this. So if you haven't been over to the Educated Homebuyer podcast, make sure you check that out. That is a subsidiary of the show, if you will. Every single week, we're talking about a topic specifically, a deep dive, 20 to 30 minutes on something that will educate you as a home buyer. So if you haven't done so, go check that out. And every Friday, we take this and post it on that podcast so you can re-listen if you're interested. All right, Josh, we got, let's see here. We actually covered this today. Yeah, go ahead.
Well, yeah, I know where you're going, but let's do this first because I think it all kind of comes together nicely. So Caesar says he just went through house shopping. He's here in Southern California, listener to the show I think it was only just about 3 weeks ago, popped up. It was getting some quotes he didn't like on his refi. We're finishing his refi. It'll be finished up tomorrow. And he just got an offer accepted here in the last 24 hours. But his experience here in Southern California, owners of good homes know what they have and are not willing to work with you. Not sure if I felt it was a buyer's market or a seller's market experience. And I think his experience was pretty good because he was a wide range of properties. He wasn't the guy that I only want this house in this neighborhood. He was looking at a lot of things. They made offers, they got close, and he stuck to his guns and didn't just say, I got to have this house at all costs. It worked out really well. And from there, a question. So literally before we started the show, we just made the decision. He made the decision to lock the interest rate on the loan. So before we get to the one you were going to answer, Jeb, Joshua Johnson says closing in 45 days. Wonder if I should just lock now. 45 days is a pretty long window. It's where I would start being open to the idea of floating. If he said I'm closing in 15 days or 21 days or 30 days, I'm probably going to say, let's take the chips off the table and ring the cash register. What are your thoughts, Jeb, on a 45-day closing? Does that change anything?
No. I think there's an opportunity for volatility in the market, right? The likelihood of seeing much lower rates, I don't think is very high. The opportunity for seeing much higher rates, not really high, but I think you could see a quarter higher and eighth lower, somewhere in that ballpark. And I don't know that it's worth the risk, to be honest. I mean, you want to sleep well at night, lock in your loan, move on, and if the opportunity presents itself later, take advantage of it. That's really
and
what
an
it is.
important thing, Jeb, that I always like to point out with this is rates pop up much faster than they come down. Like after just telling you in 7 days they came down really quick, it is more common to see a slow and steady slog down and then a spike up, slow and steady slog down and a spike up. So it's easier to get on the wrong side of it floating than it is locking, but go with your gut on that. All right.
All right.
I jumped in, Jeb, and got ahead of your question. So go ahead.
No, it's all good. We have Joshua watching from Atlanta, Kimberly from LaGrange in California. A couple more put it in there, so I wanted to give them a shout out. Brett has a question, and we answered this today. Says, how much higher of a rate would I take now to be able to do a no-cost refinance later down the road? He mentions that he hears us talk about no-cost refinancing, gives us price range. The price range is somewhat irrelevant because it doesn't really matter. But basically, the question is it better to take the best rate now or take a higher rate now and refinance for free later? So, so how do you do a no-cost refinance? You take a higher rate than the par rate in the market, right? The lender, there's a yield spread created. The lender uses that to offset your costs. That's the simple, easy answer. If I were buying a house, I would take advantage of probably the best rate I could without buying down the rate today, because you don't know how long you're going to be stuck at that rate, right? Is it going to be 30 days? Is it going to be, 3 years? In theory, you have an opportunity before that, but I think that, in my opinion, is the way to go. And then if there's an opportunity in the future to refinance, that's when I would try to do a no-cost refinance and slowly take advantage of those. I know it seems a little bit counterintuitive to what we're talking about here. But that's essentially the way I've always approached it, and that's my thoughts.
Let me throw a little bit of additional mortgage nerd in there. And then also I was rereading the question while you were looking at it, while you're answering it. Is it better to take the best rate now or take a higher rate now and refinance for free later on? A thing to remember, the reason why most people don't go with lender credits on the purchase is it's still generally not enough to cover all of your closing costs. Closing costs on a purchase are higher for the most part than on a refinance because we're able to negotiate those title and escrow fees down to a minimum. So from that standpoint, you're piggybacking off those closing costs that you're already paying. So doing the 0 point and getting a good rate is generally the better way to go. We have a listener in Virginia that we've been watching, and they took 7.625 when they could have taken 7.25, and they got a $5,000 or $6,000 credit towards closing costs on a $700,000 purchase for that. But now we're looking at it. Her hope or thought or plan was VA loan after the 210 days, she'd be able to do an IRRRL. And we've gotten really close to it, but not quite enough to be able to do it. So that's sort of going back and just support of what Jeb said, that the 0 cost or 0 point loan is generally better. It's getting you a balance of not paying a lot for the loan, not a lot of closing costs, but getting a very good rate. The other factor you have to count here is you're in Pennsylvania. Pennsylvania, a lot of the Northeast is much higher closing costs than the West Coast, Southwest specifically. So to refinance that $300 to $350 loan, instead of a $2,500 to $3,500 total closing cost that you need to absorb in that no cost refi, you're probably having $5,000 even on that smaller loan in Pennsylvania. So it's important to talk to the person that's doing your loan, have them show you what it costs for a $350,000 rate and term refinance and what that premium rate needs to look like to cover it.
All right. We got a couple others in here. Night Panda from Irvine, Kill Switch from Oregon. But we have some additional questions here too, Josh. So somebody's interested in doing the rate watch, right? Which is essentially where we watch the rate for you and then contact you as rates move down. Says, what if I don't have a mortgage statement? So Josh, how can you have a mortgage without a mortgage statement? But answer, I guess, is there a way around that?
We had one here recently. Someone said, I have a HELOC, and it was a little HELOC. They owe like $30,000, but they have some other debt they're considering consolidating. They kind of wanted to look at all of it. So send me the HELOC statement. We at least have that information. So if you have a mortgage and you don't have a mortgage statement, you can send us the details. If you don't have a mortgage and you're looking to refinance, We just need to have a conversation about what are you looking to accomplish and what would be the trigger. For those of you with a loan right now, you may be, I talked to several people this week. They're at 7 1/8. They're at 6.875. So higher than where the market is right now, but not quite enough for them to move. So the conversation we have is, okay, where you are located in your state, here's roughly what closing costs are going to look like. So how much monthly savings do we have to have for you to want to make that leap? Is it, $300 a month against $3,000 of costs? We got less than a 1-year break even. Most everyone's going to say yes. If you have higher closing costs or less savings, different people come down in different places. I literally, Jeb, there's clients that if you can save them $25 on a monthly payment, they're like, I'm in, let's do it. And there's other people like, I'm not doing this for $300. It's a personal decision. You have to know what your comfort level is.
$300. But
no cost, a no cost refinance for $300 a month.
300 a month. Yes. I thought you said $300 a year, $25 a month.
No. I'm saying there are people for $25 a month that will do it.
Yeah.
So $25 a month, you're out. $300 a month, you're in.
Yes, for sure. I did it where I saved $450 or something each time. It was just under or just over $900 when I did it. Two different times. So
when we talk, and we're sitting here, Jeb, with this volatility, I think it's prudent that with low or no cost, if you can knock a couple $100 off your payment, write it down rather than saying, I'm waiting until I get this monster $500 a month payment savings.
Agreed. Mary says, can you refinance without down payments? So Josh, I'm assuming she's asked, can you refinance without having to come up with any money out of pocket?
Absolutely.
The way you read it?
Well, I say absolutely, assuming you have the equity in the home, or you can do a no-cost loan. So we can get a lender credit. We take a slightly above market interest rate, get a lender credit, cover your closing costs. You don't have any money anywhere. But if you want to get the absolute best rate or pay points to buy it down, you're basically going to trade equity for that low interest rate. So you're not going to be required to bring in money. You're not going to have to write a check from that perspective. But you don't have to put a down payment or come in with money. We're going to use your loan amount, your proposed loan amount, against your appraised value to come up with the loan to value for the loan.
All right. Degenerate Learner says, credit union offered me a 30-year 6.5% rate on a 10% down payment with no mortgage insurance. This is not a buy down rate and closing costs are around $7,000. Is this a good deal? So I guess the first question I have is conventional loan, I assume, is what 10% down. Because if it were, VA or FHA, the rate would likely be lower than that, Josh. But what are your thoughts?
It's a good rate. 6.5 is a good rate either way, with or without mortgage insurance. Always want to say on this, did they offer this to you 2 hours ago? Because yesterday and today rates have gotten worse. So that rate may or may not still be there. Mortgage insurance, someone with a 10% down and a really good credit score is like 0.10, 0.11. So there's some savings there. It's not a huge savings, but those terms are good. I would want to know more about the closing costs here of $7,000, because Jeb, when I look at that, I go, $7,000 in closing costs is insane. There's something more there, whether it's points, whatever. But I also know that a lot of people see their disclosures, and the way the loan estimate does it, it lumps prepaids and closing costs together and says closing costs. We go, oh my God, my closing costs are $9,000. Like, no, your closing costs are $4,500 and your prepaids are $4,500.
Yes.
So I would want to know more about that before we say whether that's good or bad.
Yeah, I think that's important to note. Like I'm guilty of doing that too, saying when I think of prepaids, interest, everything that's due on that loan, I just lump it all in as one thing because it's money that I've got to come up with. So just to be clear, those two things are different, but oftentimes people interchange the words. So I think it's important to make sure you're talking about the right thing. But with that said, there's a link scrolling the bottom of the screen, guys. If you want us to look at something or want Josh to review something, you want to quote, jebsmith.net/start will get you in touch with the team and they can look it over for you. So Josh, we have AR has an interest rate of 7.9% and says they would like to refinance as soon as possible. So what we've realized in some cases, people have non-QM loans and different types of loans where they got a super high rate. Sounds like this could be the case, but what's the advice here?
7.9, you should be able to get that lower. And now the other thing, so you pointed out a couple of reasons where someone may be in the correct interest rate and there's not an opportunity for them. If it's a bank statement loan, 7.9 might be a pretty decent rate. But even at that, yeah, I'm doing a DSCR loan on our property in the desert, Jeb, and it's 7%, somewhere in that range. So there's still good options available. You may still want to look at it. The other thing that I think of, so I'm at 7.9%. Okay, well, how much do you owe? I owe $42,000. Okay, the closing costs involved in refinancing that $42,000 loan is going to overwhelm the benefit of dropping that interest rate. So I use an extreme example, but maybe you owe $142,000 or $192,000. We got to look at it, but that's a pretty easy direct comparison, one loan to the next. So use a scroll below, reach out. If you're not in a state where we service, we can get you connected with someone that can go through, give you that side-by-side comparison. But I would say anyone above 7.5% should be looking at their refinance options right now.
All right. I've got some good questions tonight, Josh.
What happened, Jeb? Like 3 minutes ago, these guys went bonkers and just asked a bunch of questions.
Tons of good questions tonight. Jonathan says, is there a seasoning period for cash out refinance on a home that was bought cash? So this person wants to pull cash out. How do they have to wait a certain period of time in order to do that?
So it depends on what type of loan you're using. If it's conforming loan amounts, Fannie Mae has a delayed financing rule where if you pay cash for a home, all your own cash, can't be dad's cash, can't be your girlfriend's cash. It literally, you have to show it's all your cash, you're on title. You can refinance right away to replenish that cash. Otherwise, you need to be on title for 6 months before you can do it. FHA, if you want to do cash out, you need to be on it for 12 months. VA, the guidelines don't specifically say, but most are going to follow that 6-month timeline.
All right. Dave says, checking in from Ohio, how long should I wait before giving up on refinancing? I bought a house for $250,000 with 3% down and a 6.625% interest rate in 2023. So, Dave, I think you probably could have taken advantage of refinancing back in September when rates were in the high 5% range for a conventional loan. But Josh, that's neither here nor there at this point. That didn't happen. Is it gone forever? Is there an opportunity?
Well, look at the specific questions. How long should I wait before giving up on refinancing? Well, let's say if Jeb and I knew for a fact that the answer is next week. If it's not there by next week, you should give up. And then 6 weeks from now, rates are at 4%. But you've given up on refinancing. I just think that the concept of giving up on refinancing is silly. The numbers are always going to tell the story. So I think what you're getting at is, hey, every month I'm paying this down. I'm getting less months left on my loan. So remember that you can do custom loan terms. So if you were on a 30 and you've paid into it, so 2023, we're almost 2 years into it, you can do a 28-year loan. You can knock it down to a 25-year loan. You might say, hey, I'm aggressive. I'm okay with my payment. I just don't like my interest rate. We can knock it down to 20 years and keep you with a similar payment. So the numbers are always going to tell you what your options are. I would never give up on refinancing for a lower rate and payment, no matter where you are in that process, because there's always an option that matches up the term to how much you have remaining, and the numbers will tell you whether it makes sense to do it or not.
All right. I see a lot of new names in here asking questions. So I just want to say thank you guys for being here. I don't know if it's your first time here or if you've been here many times before and just never asked questions, but it's because of you guys that we're able to do this and provide value to everyone. And the reality is, if you have a question, chances are it's going to benefit somebody else. So it's somewhat selfish in some regard to keep it to yourself, because you are going to help other people. And I think a lot of people will benefit from tonight with some of the questions that are being asked. So I just want to say thanks for being here and asking questions, because it does help. This isn't a question, but it's a statement, and I'm not privy to whether or not this is actually true, so I'm just going to run it by Josh. Says, so after some research, I found that you can get an FHA loan if you owe back child support, if you have a payment agreement between you and the government. So Josh, that sort of thing. Back child support, it could be alimony, it could be anything that's back taxes. Is this an accurate statement?
Yeah, you have to have an established payment plan, and you generally can't set it up now and go, all right, next month I'm going to start paying. So FHA, conventional VA, they're all going to have slightly different guidelines, but know what type of loan you're getting, and you're going to have made a number of payments, 3 to 6 payments, to demonstrate that you are actually making the payments. And on the flip side, maybe you're receiving alimony, child support, Great. I've got a decree that the court says my husband has to pay me this. We also have to prove that they actually are doing what they're supposed to do and paying it to you.
Interesting. I didn't know that. I thought as long as you had the
Because when
decree
you
that
did
said,
loans, they didn't have that. And then they realized that there were deadbeat moms and dads not paying their child support and
interesting.
alimony. So
I
they make you
didn't
prove that
know.
you're
I
actually
thought as long
receiving
as
it.
you had the documentation that says, "Hey, this is required," that you could use it as income as long as the time frame was there. So
No.
good. See, I learned too, guys. I learned from your statements and questions. Grace says, "Please explain. Can you lock a rate before you are in contract? How much time do you have to be in contract for your locked rate to be invalid?" So, Josh, let's start with the first side. How soon can you lock a rate?
So she's basically asking, can you lock and then shop for a home? You can. Not all lenders offer it. We have a handful of investors that do. It's a longer lock. So it's generally a 60-day lock that gives you time to find the property, 30, 40 days to find the property, and then 20 days or so to close on it. So they're generally, because there's a cost to the lender to hedging for 60 days, these are generally not your best price lenders. It's not the best price loan because you're getting a 60-day lock. Unless we're in the middle of 2022, when week to week rates are going up 1/4%, another 1/4%, another 1/4%, another 1/4%, which most people just froze and didn't buy homes at all. But at that point, you could say a lock and shop makes sense. But for the most part, a lock and shop doesn't make sense. We can look at the chart like we do at the top of the show here every week. We can see what the trend looks like. Unless you are in an aggressive uptrend, it generally doesn't make sense. Now, that being said, do you have to be under contract? Unique situation last night. My financial planner, Jeb, he calls me and goes, "Hey, we're just putting the verbals on this. In the next day or two, I'm going to have a contract for you. I don't like that bond chart. I want to lock it tonight. Can you lock it?" I already had this whole loan. We jumped in, we locked it because we had the property address, we had all of his details. And what happens if that deal doesn't come together, it falls apart? Well, then we don't have a lock that we're committed to because the transaction fell apart. So you can do it before, but we have to disclose within 3 days. So let's say he hadn't got his contract. Maybe something got delayed. They negotiate through the weekend and we can't disclose or he doesn't get the contract till Monday. I would have to disclose before then that if he closes on this property, here's the terms and it's a locked loan estimate, blah, blah, blah.
All right, good stuff. Eric, I want to turn a single family home on an oversized lot into a duplex. Would a bank loan me money to build one if I qualify? So, Josh, what type of loan is required to add another property to a lot and or add on to an additional property?
So construction loan would work, but it's really more of a renovation loan. And I do not. So maybe just keep that one up, Jeb. When you're answering another question, I'm going to look up Fannie Mae Homestyle Renovation and FHA 203K. If either one of those would work to do it, I'm not sure. I'm not sure. So let me research that.
Put it in. Josh.
I've got it up here, but Josh Bot takes some time while I got to type.
All right,
and
we're going to come back
stuff.
to you, Eric. We're going to see if we can get that answered for you. So let me flag that one back again before I move on. I love you. Says,
I love you too.
I will close March 14th. I've been locked at 6.65. What should I do now? Nothing. Or 6.25, not 6.65. You've been locked at 6.25. You shouldn't do anything. If you're locked, you're in a good spot. You should hang tight. So assuming your lender should be updating you with the process, your realtor should be updating you with the process. Just pay attention to them. There's not really anything you should do on the locking front at this point. It seems like you're in a good spot.
Josh Bot is awesome. Josh Bot is awesome.
Let's go back to the question here, Eric.
FHA 203K allowed. It permits structural changes, including converting an SFR into a 2-unit property. Not allowed on the mini 203K, which limits you to $35,000 or less in repairs. Fannie Mae Homestyle Renovation allowed. Homestyle permits converting an SFR into a duplex or vice versa.
Good stuff there. Hopefully that helps for you. And if you need additional assistance, you, Eric, or anybody else watching, you can use that link scrolling the bottom there, jebsmith.net/start. We'll get you in touch with Josh and the team. I don't even know why I'm putting this up there. This is impossible to answer, but it just says I'm a first-time home buyer. If I have 5% down ready by the end of 2026, after paying all my debts, do I buy immediately or should I wait to see if rates get better? I don't know what's going to happen by 2026. Even by the end of 2025, I don't know what's going to happen. So I would say come back. If there's a high likelihood we'll still be here, doing the show, and we can answer your question at that time. Or you're welcome to send us an email or something, and we can keep you on a list and reach out as things progress. Jansen, I would love to refinance and no cash out needed to lower my 7.5% interest rate, which locked in the third quarter of 2023, and save at least $300 a month on my mortgage payment. Do y'all have any options to offer? So, Josh, what's your advice on this one?
The numbers will tell us where is the market today. So if that's a standard balance loan, you have an 800 credit score, probably doable today, depending on the loan amount. Again, if you have a $200,000 loan amount, you want to save $300 a month, that rate's got to move a ton. If you have an $800,000 loan amount and you want to save $300 a month, it doesn't need to move nearly as much. Use the link below. Would love to talk to you. We go through it. We can show you the numbers of what's possible today. And if you look at it and go, cool, I'm hitting my $300 a month goal, or hey, it's $270, good enough, or I need it to be here, we add you to the rate watch with a strike rate of saying, as soon as rates hit here, we're going to be the first one on the phone. We'll get this knocked out in a couple of weeks.
All right. Josh, you've kind of addressed this question earlier, but I'm going to throw it in here just to, let's see here. Where did I do with it? This one. Just because people, I'm sure, are just jumping in now, have similar questions. So Joe says, I'm ready to refi, just waiting to lock my rate. With unemployment numbers coming in Friday, should I wait to lock?
Well, it depends on if you know what that jobs report is going to look like. If the jobs report comes in and says we lost 100,000 jobs last month, you probably want to wait till Friday. If it comes in and says we created 200,000 new jobs, you probably want to lock yesterday. I don't have a crystal ball. You don't have a crystal ball. One of our friends of the show here and the person that we rely on for this stuff, Matt Graham over at MBS Live and Mortgage News Daily, says predictions are for suckers, but he will make predictions. We'll make predictions as well. I think we're going to get
that was awesome. Those people are suckers, and we are too. So here we are.
Man, let's do that. And if I were betting, I bet we get something about in the range of what is expected, and you get a knee-jerk better, a knee-jerk worse, and by the end of the day, we're kind of where we are. I think the market wants more certainty on the chaos and uncertainty of the tariffs, and we ain't getting it in the short run.
I'm going to go out on a limb and say numbers are worse than expected in a positive way, and we don't see as big of a move as we would like to see, because some of it's already built in to the economic front.
Could be right. Could be right.
I don't know.
I never tempt the gods by saying things like I'm going to get good.
Yeah, Josh, you shouldn't, because it's backfired on us. So we don't. Yes. You don't talk about rates. Let's see here. Marcus says, let's do this one real quick. Is that still on? Marcus says, can you purchase a fixer with an FHA loan where the seller will not fix anything? You can. It's called a FHA 203K, which allows you to build the renovations into the loan. Josh mentioned another home ready program that conventional loans. Which one is it? Home
style renovation.
Home style renovation that allows you to do it with conventional. It's not quite as easy as it sounds. There are contractors involved. There are bids required. There are different things that have to be done in order to use the loan and get approved for the loan. So generally takes a little bit longer than a standard loan. So if you're interested, just make sure you're talking to an expert that understands FHA 203Ks, and don't just go to, absolutely do not call somebody on Google.
The starving loan officer.
Yeah, because I'm telling you, I've done a couple of them in my career back in the day, and back then, I don't know how they are now. It was not an easy loan to get done. I know they've simplified it a little bit, but it was a lot. So anyway,
a lot of it depends on the quality of the loan officer and the quality of the company behind them. So you guys know, for FHA loans, we are a pure broker. We broker those out. There are lenders that do them and they don't really specialize in them, but I've got two different lenders that literally they have a team that is all they do. So I get to rely on them heavily, because a 203K is essentially just an FHA loan with some unique features on the back end. And other than maybe a handful of loan officers in the country, there aren't people that specialize in them. So having that team of specialists that can make sure we're dotting the I's, crossing the T's, keeping everything moving. And just know it is not as simple as a standard transaction. We're not going to close in 15 days. It's going to have a slightly higher interest rate. You're going to refinance it once all your work is done, all that fun stuff.
All right. SF Miners says the home I'm closing has a solar loan that I am assuming. Is it possible to add that to my mortgage instead of having it on a separate loan? Josh.
So you're purchasing it. Depends on how much the loan is and how much you're putting down, because it's essentially going to get absorbed by your down payment. It's just going to get
So the
added
easy answer is
to that
no.
loan.
Yeah.
For the most part, no. I will say, there are some exceptions for energy efficient loans. So ask your loan officer. There might be an exception there, but the short answer is pretty much what Jeb said. Most likely not.
All right. And depending on what term you have on that and what rate you have on that, it might not be worth it to roll it in there. I mean, it might cost you more to finance that thing over a longer period of time at maybe a higher rate. So it's not always good to consolidate debt. Just, understand what you're financing it, the term and all that good stuff. Right. Josh, LJ says, would you purchase your first time home in 2025 if you can afford it and are approved in Michigan? So take Michigan out of the equation because it's somewhat irrelevant, in my opinion, as to what market. Buying a home is about you. It's about your life. It's about, are you ready to become a homeowner? Is it the right time for you? Are you, do you have relationship stability, financial stability, job stability, all of those things? Are you planning on being in the home for an extended period of time? I bought a new, a new house, not my first house, in November of 23. People would tell me I was crazy. I mean, I didn't know if I was buying at the top of the market at that point. I mean, if I'm being completely honest, but that wasn't really the decision. It was, hey, can I make the payment? And, if things go south, am I still in a decent position? All of those things. So that's what I would think from that perspective versus trying to figure out, tops and bottoms in markets and, factor all that crazy stuff in. So, Josh, if tariffs tank the economy, and talk about how they could impact the economy. Let's take the tank the part out. If tariffs impact the economy, what does that mean for mortgage rates?
It means that rates will get better. So who can take advantage of it? Those not negatively impacted by it. So let's say you work for a manufacturing company and the cost of the raw good steel that you guys are working on means that no one works overtime, or everyone now gets 32 hours a week instead of 40 hours a week. You may still have your job, but you're not making as much money. Rates will go down, but will you be able to take advantage? Will you be one of the people that loses your jobs when factories slow down, if that plays out that way? That's what it looks like. So if the economy tanks, absolutely, rates are going to go lower. But at the same time, are you the person who can take advantage of it? Most likely. In the great financial crisis, Jeb, we had 12, 14% unemployment. That still means that 8.5 out of 10 people had jobs. I don't expect we're going to get back. If we doubled unemployment, it means 8%. It means 1 out of 12 people doesn't have a job. And disproportionately usually impacts people at the lower end of the spectrum, less likely to be a homeowner, although certainly some people that are higher wage earners and homeowners are going to be impacted as well. So it's one of those things. Be careful what you wish for. Like we talked about, we would like to see rates just a nice, slow, steady grind lower. We would like the economy to cool down slowly and steadily, and hopefully not go into a recession. If you got a year of sub 1% growth GDP wise, you would have much lower rates without a huge negative impact in terms of unemployment spiking.
All right. Says, I just clicked out of it. Crap. Instead of putting it on the screen. I know the question. It basically says, if I'm buying another rental property, Josh, there you go. Can I use the income coming from that rental property to offset the other?
So this is what confuses people. They go, hey, I have this other property. I rent it for $3,000 a month. I can add that $3,000 to my income, right? No, we do a calculation on that, and we take the current payment less what you're declaring on your taxes. So if you say, hey, I pay the gardener $42,000 a year and I actually lose $25,000 with that rental property, we can't turn around and show a profit. And that's an extreme example, but most people do fudge those numbers and they show less taxable profit than what they otherwise make. So have one, we've got a listener to the show. She's in Florida. She moved to Florida and rented out her property here in Aliso Viejo a couple of years ago. And it's, I don't know, $500 or $600 a month positive based off of the calculation. In the real world, she has a lot more money than that coming in. But from that perspective, that net $500 positive after we analyze the tax return, that gets added to her income for qualifying.
All right. Jonathan is asking, do refinances typically cost less than purchases?
Everywhere.
Easy answer. All right. Good stuff. This is a little longer one, Josh. I'm going to read it. You might need to go to JoshBot to figure this out if you don't know, but it says for USDA loans, guaranteed loan here in Michigan, I'm looking at purchasing a lot and was told that while the house is being built, I will only pay for the interest of the land until the house is completed. Will those payments lower my total mortgage? Any thoughts on that?
So we're going to have to find out if JoshBot can get trained on USDA guaranteed. So the USDA renovation, USDA construction loans, they're few and far between. We get a lot of questions. We get a lot of people asking about them. Almost no one does them. I mean, you, the borrower, everyone has this idea that, well, hey, I can get this piece of land really cheap, or my uncle has this piece of land and I can have it. And I'm going to build this house. We're going to get it done really cheap. There are very few lenders that do these. It takes an extended period of time. You have carrying costs while you're doing that loan. While the money is borrowed out at any point on any loan, no bank, no lender is going to eat that for you. So if you're not making those payments, it is going to end up in your total loan amount and needs to be accounted for. So what I would love to do is jump on my soapbox right now and say, any of you who are looking to buy your first home, please put out of your mind the idea of buying land and building your first home. It is a spectacularly bad idea. That doesn't mean that no one has ever done it successfully, because I'm sure we'll have a couple of people pop up and say, I did exactly that in construction and I built my own house brick by brick myself. It can work out. For most of you, it's just not the reality of what's going to happen for you.
All right, good stuff. First-time home buyer here, feeling overwhelmed and confused. At what point in the process do I have to pay a lender fee or a broker fee? That's hard to say. Broker fee. Pre-qualification, pre-approval, or at closing, Josh? In this case, they're self-employed, looking at doing a bank statement loan. Does it matter what type of loan?
I do not get paid, nor does any other loan officer until the loan closes. So we don't get to charge upfront fees. If you have, you can pay for a credit report upfront. Some lenders, because those costs, I was just telling Jeb before we came on here, I just got a $258 bill for two borrowers on a loan. I was kind of shocked and appalled. And because of that high cost and not all loans closing, many lenders are asking you to pay for the cost of your appraisal upfront, or your credit report. When it comes time to do the appraisal, most lenders will ask you to do that. Again, if a company's doing 100, 150 appraisals a month and they're $600 to $800 a piece, depending on the type of appraisal, most companies don't want to float $60,000 or $80,000 every month before getting reimbursed at closing.
What?
But other than that, nothing gets paid at closing. We can't charge you for a consultation fee up front. There is no cost. The cost on our end is an investment in you and the hope of building a relationship and closing a transaction with you.
All right, Josh, we have somebody that would like an episode, same person, OS. We're going to call him Os. Would like an episode on non-QM loans. I don't think we've ever talked about non-QM loans on the podcast. Perhaps we should do an episode and talk about bank statement loans and some other things. I think it's a good episode. There's a lot of people out there looking for that sort of thing. So I promise you we will do it. Let's just say it'll be within the next 4 episodes.
For the 101 bucket, Jeb. It'll be non-QM loan 101.
Yeah, so it'll probably be about a month before we do it because we've got a video coming out. Actually, we might be able to do it sooner. Maybe we talk about it sooner than later. So we'll update you next week when we put it on the calendar, but we will discuss it. That said, Josh, any red flags for things to watch out for on just bank statement loans, non-QM loans, anything that's not normal?
So here's what to know. I tell people, if you're shopping for a loan, all reputable lenders should be within a pretty narrow range. Like best to worst, if it was 0.25% difference on a conventional or an FHA loan, I would be surprised. Non-QM loans, whether it's bank statement, DSCR, any of that stuff, it can be a pretty wide range. So at a minimum, I think you don't want to go to a lender that is a bank and does non-QM loans. You at a minimum want to be working with a broker that has many, many sources. Sometimes that source means flexibility. Sometimes that source means the best terms, whatever that is. The other thing that I would say on this, these aren't really red flags, they're just things to be aware of. People always ask, they're going to do an FHA loan. I want to make sure I don't have a prepayment penalty. So any QM loan, FHA, VA, USDA, Fannie, Freddie, cannot have a prepayment penalty. So on these, they can have prepayment penalties. You don't have to take them. Most lenders don't say you have to have a prepayment penalty. The longer the prepayment penalty, the more they can guarantee of their profits and the more they're willing to pay for that loan, AKA give you a lower interest rate. So you can manipulate it with interest rate. The more you can document, even within the concept, for the most part, if you can only document 6 months of bank statements on a bank statement loan, you're going to get worse terms than 12 and often slightly worse on a 12 than a 24. So just, you want to document as much as you can. You want to have multiple options to shop. You want to know how that prepayment penalty impacts what you're going to end up with in terms of terms.
All right, here's the deal. We typically go an hour. We've got some questions, kind of rapid fire, Josh. Let's get through this stuff. My family is waiting on me this evening. Real Deal Memphis just says hi, Josh. So I wanted to point that up.
Alexis is a great realtor. If any of you are in Memphis and need help, we will get you connected to her.
There you go. Good stuff. Thanks for joining us, Alexis. This is an easy one to answer. First-time home buyer, if I have a large amount of down payment to use, should I still use FHA loans, Josh?
Numbers never lie. And the funny thing is, I'm ready to get on a call with some borrowers here in Southern California, borrowing about $1 million. They're going to put about $100,000 down. So less than 10%, a little bit less at their purchase price than 10%. And we're going to go through exactly that. FHA or conventional. FHA is going to have a lower monthly payment. Conventional is going to have a lower loan amount, and you have to decide what's most important to you. There is not a right answer. You have to have an advisor on your side who can help you break down those numbers.
Good stuff. And if you want to talk to Josh, the team, jebsmith.net/start will get you in touch with them. Josh, Orange Blossom says, 67 years old, full-time work, and planning to buy a house. Great FICO or good FICO. Would lenders approve my loan if I just have Social Security income?
Well, she's got full-time work. This is saying if I have Social Security income, Social Security income is a bonus.
Yes, full-time work too. Yeah,
that's a plus.
But just say if you just had it. If you just have it,
100%. If you have, we talked about the borrower or the listener here to the show. She's in Florida. She's got some disability income. She's got Social Security income. She's got rental income. She doesn't have a job at all. All of that income is enough to qualify for the home. So lenders don't discriminate about income other than the fact that they want it to be recurring. If we can show that you're likely to receive that for 3+ years, we're going to use that income to qualify.
All right. Let's see. Does buying down the rate, even if the savings takes me 5 years to recoup, but technically high income, I can make it back less than a year, worth it? So, Josh, we kind of talked about this today on the show. Should you buy down the rate if it's got a longer recoupment period? If you've got money in the bank and you're not necessarily worried about having those funds on hand, and you can recoup it in another way. Does that make sense?
To me, it doesn't. That's why we don't do what the call center loan officers do. If you ask for numbers, we're going to start with 0 points, get a baseline, figure out the right loan program. Then if you want to see the options for paying points or getting a lender credit, then we'll give you those adjustments so we can see what that looks like. For most people, you do not have the certainty into your future. Jeb, again, on the podcast today, we talked about this, the one we recorded today. You as an individual think you have certainty on what's going to happen, but you actually don't. A lender, when they make 10,000 loans, they have some certainty on how those 10,000 people are going to react. So they can price a loan with that break-even point being at 60 months, knowing that most people will refinance in less or more time than that. You think you know what your situation is, but I don't like sunk costs when I don't absolutely have the certainty of where I'm going to be. If I have a great year next year and have a bunch of money sitting in the bank and a wonderful home comes on the market at a great price for me, I might go buy it, even though I have no intention of moving right now. I prefer the flexibility of not having sunk costs.
All right. I missed this one earlier. LJ, what would you say are big red flags on a home inspection? In this case, it's the 1970s brick home. I would say for me, like brick, no brick, whatever, different areas, different style of homes. But I'd say I always focus on the big ticket expensive items. Look at the roof, look at the HVAC, the furnace, the air conditioner, if there is one. Water heaters, not that expensive, but it is, a couple $1,000 to replace. Plumbing, electrical. Those are the things that and appliances, right? Those are the things that are going to cost you the most money to replace. Those are the items that I would focus on in the inspection report. What's how old are they? How soon will they need to be replaced? What's that cost going to be when they need to be replaced? That's really it. I mean, outside of the foundation and stuff like that on a home, that's where you got to focus your time. So hopefully that is helpful. We are here at an hour, just over an hour. If we found any value tonight, if you found any value, do us a favor, hit that thumbs up. If you haven't already subscribed, check out, the channel. You can go over to the Educated Homebuyer podcast and check that channel out too. And if you're there, and check out the Jeb Smith channel. But either way, we appreciate you being here. We're here every Wednesday. If we didn't get your question tonight, make sure you come back next Wednesday at 5 p.m. and we will answer your question. If you want to get in touch with Josh, you can do so using the link scrolling below, jebsmith.net/start. That'll actually get in touch with me as well if you need a real estate agent. Any final parting words, Mr. Josh?
No, nothing really. Just again, get your questions answered. I'm not going to throw it up here, but John asked the question, what's the main thing to look for when finding the right lender? Are they all the same? The answer is no. They're not all the same. All realtors are not the same. And if you only talk to one, I'm not saying go get pre-qualified by 10 lenders. I'm not saying interview 10 realtors, but talk to more than one. You will quickly see it's an 80-20 industry on both sides. You want to get not just one of those top 20%, you want the top 20% of that top 20%. So a top 4 or 5% realtor and lender in your court, and you will know it when you see it, when you have the conversation, that they're asking you better questions. They're hearing you better. They're offering suggestions. One of my favorite books is a book called The Challenger Sale. It's a book for salespeople, but it basically says your job is to help the consumer figure out what they want and need. If you aren't able to teach them how your industry, your product solves their problem, you don't need to be taking money from them. And unfortunately, we have a ton of people. I get to see it every day. I get people that the lenders have told them the craziest things you've ever heard that are at dead wrong, 180 degrees opposite of what you should be doing. And same thing on the realtor side. Jeb, you get questions from people all the time that are just in quite the predicament. Save yourself, measure twice, cut once, talk to a couple people. Use the easy button, use the link below and get connected to us. If Jeb can help you here locally, if not, you're out of the area. We have great people everywhere in the country. Same thing on the loan side. We can help you in 20 states. We've got people in all 50.
We've helped hundreds of people. We can help you too. And we'd love that opportunity. So make sure you check us out. Till next week, guys.
Wait.
Bye, right.
Wait. You got a super chat.
Adios.
You got a super chat. Give him a shout out.
LJ, $2 super
LJ.
chat. Thank you for being here. We appreciate you. Just seeing that. So thanks. Till next time, guys. Adios.
Amigos.